Hey guys, you've joined us live at Money Control. I'm Manisha Gupta and we're talking about currencies today because there's a lot of movement happening here. The Japanese yen and the euro have been on a slight decline. If you look at the dollar index, well, that is trading at a 4.5-month highs above 105. Well, a lot of people feel that that is not where the dollar index will sustain as we see just a bad data perhaps, or as the interest rate cuts, the noise gets stronger, you will see dollar index come down. But until then, what is it looking like for the currency as a market? For that, we are now joined by Amit Pabari of CR Forex. Amit, hi, thank you so much for joining us. What is your sense to begin with in sense of dollar index? The sudden surge that we've seen from holding around that 102 to 104, 105 is just come in a jiffy.
Our good afternoon, first of all. Our in-house view is that dollar index should face a very tough resistance, close to 105.50 and 106 kind of a level, and gradually it should move towards 102. That is the first target. Second target is 100 kind of a level. The reason why we think dollar index is going to come down, because we expect Fed to be very aggressive in interest cut cycle in next coming months. If you see US debt as of now, US debt is at $34 trillion. And on the interest, they are paying close to $1.2 trillion, which is 28% of revenue what they are earning. Apart from that, $1.2 trillion they are spending on social security and close to 1.05 trillion they are spending on defense. So basically the rising debt and rising interest is a burning problem for Fed, and Fed will be very aggressive in next couple of months to reduce the interest rate. Once that reduction of interest rate cycles starts, dollar index is going to come down again.
Amit, how are you looking at the Indian rupee in the meanwhile? Because a lot of people were perhaps suggesting that by the time you have elections, you could be looking at a righter side of 83, but we've gone on the wrong side of 83 right now. So what's your sense and what is the range that you would look for this quarter at least?
Manisha, last time when I came at your interview, rupee was trading close to 83.30. Fortunately, again, or unfortunately, the level is same, trading at the same level, 83.35.40. What in-house research team of CR Forex is telling that 83.50 to 83.60 is a very, very strong resistance for the pair. And in the year of 2024, we expect rupee to move towards 80 to 50 first target. Second target is 82. If both those level breaks, then we might be luckier to get 81.5 kind of levels also. There are 3 to 4 important reasons why we feel that. First important reason is flow. In the year 2014-15 financial year, we have received flows close to $45 billion, which was highest in Indian equity and debt market. Recently, 2023-24, the flows were close to $41 billion. And in last 2-3 months, we have received a flow close to $8 billion. Because of stronger fundamentals, lower inflation, we expect money to come in Indian equity market. That is the one reason. Second, we expect bond inflows to come in post-June, close to $40-50 billion. That is positive. Third positive factor is reducing current account deficit. From April 2000 to December 2022, our current account deficit was close to $64 billion. It has reduced by $34 billion because of better inflows and stronger service exports. Going forward, we expect current account deficit to further reduce. So these are the main 2 reasons why we expect flows will come in and rupee will appreciate. Third, at this point of time, RBI is very, very strong. Reserves are at all-time high. Any problem come, we have seen RBI have been adequately addressing the issues since last 4-5 years. We're not expecting any kind of a runaway in the currency, and 83.50 is going to act as a strong resistance, and gradually rupee is going to get stronger towards 82.5 and 82 level in 2024.
All right, that's nice to know. But the other thing that really seems to be bothering a lot of traders within the currency market is that RBI circular that came in January, but the deadline now is on 5th of April. That is when you cannot trade currency derivatives if you do not have an underlying exposure. So, Amit, we do understand that a major chunk, maybe 60 to 70% comes in from these traders. How are you looking at this segment to begin with, and how much of a decline in volumes can we expect from 5th of April?
This is too early to comment as of now.
Okay.
Let the clarity come from the exchanges and let the clarity come from RBI and SEBI. Then only we'll be able to answer that question.
Amit, just to get a sense on what is, okay, we'll wait for that clarity, but what is the proprietary trade or the retail trade or hedging trade that we see as of now in currency derivatives?
As far as hedging is concerned, it will not get affected because you can always produce an underlying, and definitely an hedger can hedge in exchanges. For hedger, that is not a problem. But definitely who are trading on an individual basis or proprietary basis, there can be some concern. But I think technically speaking, RBI or the concerned body will come up with some kind of clarity, because if you want to create a market, there has to be a liquidity in the market. Hedgers and traders both combinedly help in creating a liquidity. So exchanges and the governing body will understand that issue, and probably they are going to come up with some kind of clarification on that circular.
I understand that, Amit. I mean, this came in the month of January. The reason the market is talking about it yet again is because, one, there is no clarification. Two, the exchanges have already told brokers and their members that this is what the latest circular is all about. And 5th April is not too far away. I mean, we only have this week to go to. I mean, how concerned are you, or do you think this perhaps was a progression to begin with?
I will answer that in two parts. As far as my company is concerned, basically we are advising to exporters and importers, so that will not get affected.
Sure.
On a personal note, when we do run a personal proprietary trade, that is going to get affected definitely. But we will pray to the Almighty that some kind of a clarification comes, and all traders like us can again start participating in currency trading.
Sure. Amit, the final question, and I'll let you go, I promise that. So, when it comes to rupee, I mean, that's one part of it, but I do understand that when it came to currency derivatives, there was a Japanese yen and a euro as well, and the markets did see some amount of liquidity come in for these, given the fact that these currencies have moved a lot.
Overall, when you are trading in euro USD and GBP USD, I find the entire volume on the currency derivative side, 80 to 85% comes from dollar rupee pair, and rest 20% is coming from other currencies, including euro INR, GBP INR, Japanese INR, and euro USD and GBP USD. So there is some amount of disruption will happen, but we have to wait for the exchanges and the governing body to come up with a clarification.
All right. That's a very, very hopeful, Amit Pabari, that we have for you. We will wait for that clarification, Amit, and come back to you and understand on what it really means from the next week onwards. Thank you so much for that time.
Yeah, thank you.